They should not have allowed RBS to buy ABN AMRO. I think they should have gone to them privately well before the crunch and said, why don't you sell it again at a loss because it's just too difficult for you to manage and it's all too complicated. And I would like to see them split the banks up more in Britain because I don't think we have enough competition in the market. But anyway, they decided on the wrong response at the end of 2008, and they then decided, having publicly flagellated the banks for bad performance and inadequate finances, that the taxpayer should go to the rescue. I couldn't believe it when I saw what they were proposing. And when I went into the House of Commons to explain to my colleagues there the figures, I could see a lot of Labour MPs having an intake of breath when I explained just how big the liabilities as well as the assets of these banks were, and that we were now standing behind all of the liabilities of these massive banks. Very roughly speaking, RBS was a 2 trillion bank and Lloyds-HBOS was a 1 trillion plus bank. So we were putting the state behind assets and liabilities of over 3 trillion when our national income is only 1.5 trillion a year, and when the government share of the national income collected in taxes is only about 40% of that. So we were putting something like 6 times the tax revenue of the country at risk with these 2 enormous banks that they decided to buy shares in. And I tried to get them to adopt a different strategy. I then recommended, once the damage had been done with the publication of these adverse findings on their finances, that they should produce with the bank a plan. They should say they would make lender of last resort short-term money available so there was no run on the bank. There would be no need if people knew that the Bank of England stood behind the deposits with liquidity, but that the banks would be forced into asset sales and raising profits and cutting costs and all the other good things they need to do to sort out the mess. This view was not popular. It wasn't given very much airtime because the government and Mr. Cable were quite determined upon bank nationalisation. I think a ruinously foolish strategy, and one which they pursued. In 2009, we've entered the 3rd phase of the strategy, which one might call the punk monetarist phase. And it's almost unbelievable. If you'd been writing a drama about how a Labour government might get into trouble financially, you'd never dream of inventing anything this horrendous and this extreme. But they decided, all else having failed, to invite in the monetarist gurus who told them, quite rightly, that there wasn't enough money in circulation, particularly in the private sector, and that they needed to do something about that. And they have converted that into the most extraordinary policy to provide eternal cheap financing for an ever-expanding public sector, not, of course, to provide money for the private sector to try and rescue it from the throes of the recession and the crunch which it is heavily enveloped in. So how does the money-go-round work? Well, it's a sort of double-banked money-go-round. There's the money-go-round where the Bank of England literally prints money to buy up second-hand government bonds, and they've asked the government have asked the Bank of England, or agreed with the Bank of England, to buy up £175 billion worth of bonds in a year, which just coincidentally is the same as the amount the government thinks it needs to borrow for the year. And they just coincidentally issue rather similar new bonds for their current spending to the bonds they're buying up from the market to warehouse in the Bank of England. So it means that they can borrow the £175 billion at relatively low interest rates without anything apparently having gone wrong, which is obviously very convenient. But then for the future, they've also, through their regulator, said to the banks, you've now got to run your banking model with much more cash on your balance sheet, and our preferred way for you to hold the cash is to lend it to the government, because we will regard that as liquidity. You need to buy lots of short and medium-term government bonds. Surprise, surprise, there will be quite a lot around, so it won't be any problem for you finding these bonds. And over the next couple of years, they're going to ask the banks to move to much higher holdings of national government bonds, which will help the money go around further. So why isn't the money getting to the private sector? Well, because the regulator is really saying to the banks, this money must go to the public sector because that's the way to up your cash ratios and to try and strengthen your capital base. And anyway, it's easier business having subsidized money from taxpayers, lending it back to the government and so forth, than going through all that quite expensive work of trying to decide which risk is a good one and which kind of loan you want to put on your book. So we have this two-tier world now where the government can borrow at somewhere between 1% and 4%, depending on the length of term it wishes to borrow for, whereas the private sector is borrowing at somewhere between 8% and 20%, depending on who they are and how friendly their bank manager is. And so we have a structure of interest rates which is bizarre. We have a 0.5% official rate, but nobody can do business off 0.5. We have deposit rates for savers 2 to 4 now, if you're lucky, if you lock it up for a little bit, because nobody's going to lend their money for 0.5% or whatever. And then we have these still very penal rates to borrow money in the private sector. So it's not working. So briefly, what should you do? Oh, you need to do all sorts of things. But they say they believe in counter-cyclical banking regulation and monetary policy. Will prove it. So they need to relax the cash and capital controls on the banks at the bottom of the cycle, which is somewhere where we now are, and they need to get ready to tighten it when we get a decent recovery, but not to threaten that too soon or to do anything too difficult. They need to reduce the government deficit so that there is some space for some of the money to go into the private sector, which is dreadfully starved of cash. And above all, I think they need to understand that banks do need to be fixed. And that is now a task for government with respect to RBS and to Lloyds-HBOS, because the government is the leading shareholder representative and should play the shareholder role. And the shareholder should want to be very active and very interventionist when you see the track record of Lloyds-HBOS and RBS in the last couple of years. The owner should not be satisfied and should be making changes. Ideally, the owner would say, we're going to split you up. We're going to create 4, 5, 6 UK clearing banks out of the 2 we've got. They've already got the different brands. They've already got quite a lot of branches. Split them up, return them to the private sector with suitable balance sheets. Try and get rid of as much of the dangerous debt with them as possible, of course. You can sell the overseas assets any way you like. It doesn't really matter. But the market you need to improve is the British market. And the British market doesn't have enough banks. It has a few big banks that I don't think have served it very well. It would appeal to the public mood, because the public is not too keen on banks and bankers at the moment for obvious reasons, but it would give us a chance of economic revival, because I do think our banks were a bit of a problem trying to get a fast-growing, decent economy, even in the good years, because they weren't very good to the smaller customer and so forth. I think if we split them up and had more smaller banks that were hungrier, we might start to get somewhere. Just a few ideas on what we should now do.